Hi everyone, in this video I'm going to answer the question if Lowe's is an excellent dividend stock to buy after its third quarter earnings results came out. So let's get right into it. The major theme here is that there's no major slowdown at Lowe's. There was fears that this home improvement stock would experience a significant slowdown following the boom in sales that ensued following the earlier stages of the pandemic. That hasn't happened just yet. So overall revenue in the third quarter increased to 23.5 billion. That was up from 22.9 billion last year. Adjusted earnings per share increased by 19.8% to $3.27. Lowe's recognized a pre-tax $2.1 billion asset impairment of its Canadian retail business. This is a non-cash expense that's written down because it lowered its prospects of its Canadian retail business, which makes up less than 10% of its overall sales of Lowe's. The professional customer segment is what helps sales grow for Lowe's in the most recent quarter, and that's understandable. Remember, during the earlier stages of the pandemic, people were hesitant to let professional contractors into their homes, and so they delayed a lot of those projects during the earlier, I would say year and a half, 2 years of the pandemic, and now they're taking on those long delayed projects, and that's helping sales grow. And of course, the professional segment makes up more than or roughly half of the $900 billion in spending in the home improvement industry. So this is good news for Lowe's, and this is a category that it has trailed its rival Home Depot, and the fact that its sales in the segment grew 19% is great news for Lowe's investors. For all of 2022, Lowe's is expecting its gross margin to slightly improve year over year. That's impressive considering the backdrop of macroeconomic headwinds that's causing rising costs for businesses worldwide. The fact that Lowe's is able to pass along those prices to its consumers and not experience contraction in its gross profit margin is impressive considering so many other businesses are reporting contracting gross profit margins. Inventories of 19.8 billion was up from 16.7 billion year over year. Much of that is from inflation, right? They're paying more for the items they're getting, and so the value of inventories is up year over year. Even though the number of units might not be up year over year, just the value of those units is higher because Lowe's is paying more for those units. Long-term debt is experiencing a bit of a troubling trend here. It increased to 32.9 billion, which was up from 23.9 billion from the same time a year ago. And this is something investors should keep an eye out for, although it's not a problem just yet for Lowe's because the company does deliver robust earnings and cash flows, and it has enough to support these debt payments. It's just something to keep an eye out for longer term because interest rates are rising, and when it comes times for Lowe's to refinance this debt, it may have to pay a higher interest expense. Just something to keep an eye out for, and hopefully Lowe's will be mindful of this and not raise the debt going forward from here on out. In the 9 months ended October 28, the company paid dividends of 1.7 billion. That was up from 1.4 billion during the same time the prior year. So a robust increase in dividends by over 300 million from Lowe's in the 9 month period compared to last year, and this is supported by excellent earnings growth and cash flows. So dividend investors can count on Lowe's to continue increasing its dividend over the near term and the longer term because it's supported by solid earnings growth. And finally, the business is managing an orderly slowdown following the surge in sales during the initial stages of the pandemic. There has been this constant fear from investors that Lowe's and the home improvement industry overall would experience a snapback decline in sales when economies reopened and consumers had more options on where to spend their money. But that hasn't been the case. Of course, sales is not growing, the 30-40% rate that it was growing for Lowe's during the earlier stages of the pandemic, but that wasn't to be expected longer term. That was a brief surge that was fueled by consumers staying home, restaurants being closed, travel being restricted, and stimulus checks. So the fear was that instead of not growing by 30%, the fear was that sales would decrease by 20 or 30% at Lowe's to, go back to pre-pandemic levels, but that hasn't been the case. Lowe's has actually built on top of the growth that it achieved during the pandemic. So that's great news for Lowe's stock investors. So, to answer the question, is Lowe's an excellent dividend stock to buy right now? I would say yes. If you have a long-term outlook and you are an income investor, a dividend stock investor, and you're looking to add Lowe's to your dividend stock portfolio, then yes, it's an excellent stock to add right now. The company has shown resilience amid difficult macroeconomic headwinds, and the fact that it was able to perform so well and execute so well during the different types of operating environments during the pandemic is great news for dividend stock investors. So yes, you can feel good about adding Lowe's stock to your portfolios. Okay, so that's all I've got for this Lowe's earnings update. If you've gained any value from this video, please go ahead and hit the like and subscribe button. It'll help me make more videos like this one. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.